For this month, and likely the next several months, I will be using my favorite AI voice to narrate the content. If you have questions about anything, please join our community via the link in the pinned comment. Welcome to the second month of the 2025 PineScript series, where I teach members of our community how to develop algorithmic strategies for trading daily charts. The purpose of this series is to teach one new algorithmic strategy each month in order to give our members the foundation they need to develop trading strategies of their own to grow their wealth. If you are new to our community, you need to follow the roadmap. You should not be trading if you have not already built up capital, which can be accomplished through other methods that we teach. Along that note, I want to highlight a success story from this month. One of our members was let go from his restaurant job, but because he built up multiple income streams, he is still financially stable and moving up the socioeconomic ladder. Having multiple sources of income is the key to stable financial independence and wealth. Before diving into this month's strategy, I want to share how and why I do manual execution. When a lot of people hear the word algo, they assume it means a bot that handles both signal generation and trade execution. In many cases, this is true, but for the purposes of teaching trading, the most difficult part is actually coming up with a consistently profitable strategy. If you are new to algorithmic trading, I recommend executing manually before transitioning to automated execution. Doing so will get you mentally prepared for the emotions that come with algorithmic trading. The other reason why I execute manually is because I use options as leverage. In this example, we get a signal at the end of January. Since we cannot take a trade after the market has closed, we have to enter the following day if the market is at or below the signal price. In this case, the market gapped down, and I bought call options shortly after the market opened. When I am looking to purchase options for leverage, I aim for at least a 0.7 delta and at least 60 days until the option is set to expire. I also like to wait a few minutes after market open since options prices take some time to update, based on the current price of the underlying. It is not my intention to explain how options work in this series, so please use other resources to learn about them. To exit my trade, I place a conditional order matching the exit condition. In this example, I plug in the previous day's high as the threshold the market has to be above, and I set the order to submit in the last 15 seconds of the day as a proxy for the market close. If the exit condition is not met, I grab today's high and create a new conditional order to execute in the last 15 seconds of tomorrow's market hours. If you have questions about this, please ask in our community via the link in the pinned comment. One of the questions I frequently get is, what happens if the market has a gap open the day after the signal? In this case, I just place an alert to trigger if the market crosses below the signal price. Some platforms allow you to place a limit order on an option based on an estimate of the underlying's price, but I have not found this estimate to be reliable. If the market meets the exit condition for the trade before I am able to enter a position, I skip the trade. This is because the backtest assumes we are filled at the signal price or better, and we should try to replicate the backtested strategy as closely as possible. So, what actually happened in this trade? Well, the market gapped down 3 days later due to a weaker than expected CPI report, which allowed me to enter the position. The market rallied after the gap down and into the close of the next day, triggering the exit condition. Now let's talk about this month's trading strategy. As with all strategies, you first have to start with an idea that you believe has an edge. In this case, I noticed that in most bull markets, when the index closed a bull bar and then engulfed it with a bear bar the following day, it would have been profitable to buy the close of the engulfing bear bar and hold it until the market closed higher than the previous day's high. You'll notice this exit condition is the same as last month's strategy. To be honest, this is my favorite exit condition for daily chart trend following strategies, and you will see it used for most strategies taught in this series. Before moving on to the rules and backtest results, I want to emphasize the importance of testing and verifying ideas yourself. Just because the engulfing bear bar is a well-known candlestick pattern does not mean you should assume it does or does not work. One of the interesting things I see in trading communities is that most people in them are not profitable, but at the same time believe ideas that have not been proven or disproven. Since it is not possible to make money consistently without a mathematical edge, these traders continue to lose money year after year, while blaming their failures on psychology or something else they cannot prove is the reason they are losing money. By focusing on algorithmic trading, you will naturally avoid this trap. Here are the rules for the first iteration of the idea. For a day to close as an engulfing bear bar, the day before must have been a bull bar, and today must have a close below yesterday's open and an open above yesterday's close. If these conditions are met, we buy the close. We exit when the market closes higher than the previous day's high. Here are the results. This first iteration of the strategy would be tradable for most people. It wins almost 70% of the time and returns a little over $2 for every dollar risked, while maintaining a drawdown of less than 5%, assuming a $50,000 account size. However, the goal when creating an algo like this is to make it a master of its setup. I am not sharing the chart in this slide, but when I was browsing the trade signals, I noticed sometimes it would give a buy signal on an engulfing bear bar that had a decently sized bottom tail. Since I want to capitalize on bearish overreactions in an instrument that is usually in a long-term bull trend, I created a second variation where we filter out engulfing bear bars that do not close near their low. The new entry condition added in this second iteration requires the engulfing bear bar to close in the bottom 20% of its range. The rest of the strategy rules remain the same. Here are the results. As you can see, the net profit increases by roughly 1%, despite taking 100 less trades than the first iteration. The win rate also increases to just under 75%, the drawdown is reduced, and the profit factor almost doubles. This is what typically happens when you make a trading strategy more efficient. Many beginner traders believe that more trades equals a higher net profit, and so they bias towards single strategies or setups that trade frequently. However, you will generally make more money by trading only the best setups and skipping ones that are questionable. Combining several highly efficient algorithmic strategies will generally net you more profit despite being in the market less. The last thing I want to mention is that there will be no second video this month where I show you how to code this strategy in PineScript. The reason for this is because you already know everything you need to code this strategy based on last month's coding video. It is my challenge to you to take these rules and code them into a PineScript strategy yourself. If you need assistance, please ask in our community by using the link in the pinned comment. Thank you for watching, and I wish you the best of luck in your trading journey.